Did you know that approximately 80% of day traders lose money in their first year of trading? This shocking statistic underscores the high-stakes nature of day trading. It's a domain where fortunes can be made or lost in a matter of minutes. For every success story, there are many who face financial setbacks. This fact alone should prompt any prospective trader to think carefully about their approach. Day trading involves buying and selling securities within the same trading day. This requires quick decision-making and a solid understanding of market trends. Many are drawn by the potential for significant profits, but few consider the substantial risks. Before diving in, one must be fully prepared, both emotionally and financially. Understanding how much money you need to start day trading is crucial. Without adequate capital, you may find yourself unable to handle the market's volatility. So, how much is enough? The answer isn't straightforward, but let's explore the key factors. Day trading is an investment strategy where you buy and sell financial instruments within the same day. The goal is to capitalize on small price movements. It requires a deep understanding of the markets and a quick decision-making process. Many are attracted to it due to its potential for quick profits. However, day trading is not a get-rich-quick scheme. It demands discipline, research, and a significant financial investment. Understanding the financial requirements before starting is crucial. Without this understanding, new traders may find themselves overwhelmed and underprepared. Financial understanding helps in managing risks and setting realistic expectations. It's important to know that not all your trades will be profitable. Therefore, having a solid financial plan and sufficient capital is necessary. This ensures you can withstand the inevitable losses and continue trading. Knowing how much capital you need helps in planning your trades and managing risks. It also determines your ability to stay in the game long enough to develop your skills and strategies. So, let's delve into the factors that influence your startup capital. How do you determine the necessary startup capital for day trading? Several factors come into play. First, consider the type of instruments you wish to trade. Stocks, forex, and futures all have different capital requirements. Stocks typically require more capital compared to forex or futures due to higher pricing and margin requirements. Next, think about your trading strategy. Are you planning to trade full-time or part-time? Full-time trading requires more capital to sustain your living expenses and cover potential losses. Part-time trading might allow for a smaller initial investment, but it also limits your potential earnings. Another factor is the regulatory requirements. In the US, the Financial Industry Regulatory Authority, or FINRA, mandates a minimum of $25,000 for day trading stocks. This rule, known as the Pattern Day Trader (PDT) rule, ensures that traders have sufficient capital to cover their positions. Lastly, consider your risk tolerance and financial goals. How much are you willing to risk per trade? What are your profit targets? These questions help in determining a realistic amount of capital needed to start day trading effectively. Different trading strategies require different amounts of capital. Scalping involves making dozens of trades daily, needing significant capital. Swing trading holds positions for days to weeks, requiring less capital. Position trading holds trades for weeks to months, needing more capital. Proper risk management and strategy are key to success. Hidden fees and emotional trading. One of the common misconceptions about day trading is underestimating the hidden fees. These can quickly erode your profits. Brokerage fees, data subscriptions, and software costs are just a few examples. It's essential to account for these expenses when planning your startup capital. Emotional trading is another significant challenge. The pressure to make quick decisions can lead to impulsive trades. Fear and greed are powerful emotions that can cloud judgment. Many traders end up chasing losses or holding on to losing positions for too long, leading to significant financial losses. Market volatility adds to the emotional roller coaster. Prices can change rapidly, making it difficult to stay calm and stick to your strategy. This is why having a solid trading plan and sufficient capital is crucial. It allows you to weather the ups and downs without making hasty decisions. Understanding and managing these challenges can make a significant difference in your trading success. It's not just about having enough money to start, but also about being prepared for the hidden costs and emotional aspects of day trading. Market volatility and its impact. Market volatility is a double-edged sword for day traders. On one hand, it provides opportunities for profit through price fluctuations. On the other hand, it increases the risk of significant losses. Navigating this volatility requires a solid understanding of market dynamics and a robust trading plan. Volatility can lead to sudden and unpredictable price movements. This can result in slippage, where trades are executed at a different price than expected. For traders with limited capital, slippage can quickly deplete their funds. Therefore, having a buffer in your trading capital is advisable. Another impact of market volatility is on margin requirements. Brokers may increase margin requirements during volatile periods, meaning you need more capital to maintain your positions. This can catch traders off guard, especially those with tight budgets. To manage volatility, experienced traders recommend diversifying your trades and not putting all your capital into a single position. This spreads the risk and helps manage potential losses. Understanding these dynamics is crucial for anyone looking to start day trading successfully. Minimum recommended starting capital. What is the minimum recommended starting capital for day trading? Experts suggest starting with at least $25,000. This aligns with the PDT rule and covers potential losses and fees. It allows you to use margin accounts, amplifying your buying power. It also helps diversify trades and manage risks. Starting with less may limit trading effectiveness and increase risks. Some advocate for $50,000 to $100,000 to provide more room for error and growth. Ultimately, invest what you can afford to lose. Start with a realistic and sustainable amount. Importance of risk management. Risk management is crucial in day trading. It involves setting limits on losses. This protects your capital. Proper risk management ensures long-term success. Use stop-loss orders to limit losses. Diversify and manage position sizes. Risk only 1 to 2% per trade. Manage and minimize losses for success. Summary of key points. Day trading is a high-risk, high-reward activity that requires careful planning and sufficient capital. Starting with the right amount of money is crucial for navigating market volatility and covering hidden fees. Understanding the financial requirements and having a solid risk management plan are essential for success. We discussed various trading strategies and their capital requirements. Scalping requires a larger capital base, while swing and position trading can be less capital-intensive. The importance of accounting for hidden fees and managing emotional trading cannot be overstated. Market volatility can impact your trades and margin requirements, so having a buffer is advisable. The minimum recommended starting capital is generally around $25,000, but more is better to provide room for error and growth. Risk management strategies, such as stop-loss orders and diversification, are essential for protecting your capital. By understanding these key points, you can better prepare for the challenges of day trading and increase your chances of long-term success. Reflecting on financial commitment. Starting day trading requires a significant financial commitment. It's not just about having enough money to trade, but also about being prepared for the associated costs and risks. Reflecting on your financial situation and goals is crucial before diving into day trading. Consider your current financial stability and how much you can afford to risk. Day trading should not jeopardize your financial well-being. It's important to have a separate fund for trading, distinct from your essential savings and expenses. Think about your long-term financial goals and how day trading fits into them. Are you looking to supplement your income, or are you aiming for full-time trading? Your goals will influence the amount of capital you need and the strategies you employ. Reflecting on these aspects helps in setting realistic expectations and preparing for the journey ahead. Day trading is a challenging endeavor, but with the right financial commitment and preparation, it can also be rewarding. Encouraging reader engagement. Now that you have a deeper understanding of the financial requirements for day trading, we encourage you to share your thoughts and experiences. Have you started day trading? What challenges have you faced? How did you determine your starting capital? Engaging with other traders can provide valuable insights and support. Learning from others' experiences can help you avoid common pitfalls and improve your trading strategies. Join trading forums, attend webinars, and connect with experienced traders to enhance your knowledge. We also encourage you to continue your education on day trading. The market is always evolving, and staying informed is key to success. Read books, take courses, and practice with demo accounts before committing real money. Remember, day trading is a journey that requires continuous learning and adaptation. By sharing your experiences and learning from others, you can navigate the challenges and improve your chances of long-term success. Bye for now. Like, share, comment, and subscribe to our channel for more content like this.